This is the power 3. This is what the daily candlestick looked like from 9:30 open. Small little movement lower, rallied up, creating the high of the day. I'll get into that high of the day in a second. And then closing here. So we have another classic buy day. Open, decline, Judas swing, rallies up, closes on the high, working that fair value gap. The 9:30 open was essentially near the low of that shaded fair value gap. Here is the opening range gap, which is the regular trading hours. You can see that difference between where we closed previous day and where we open at 9:30, that little shaded area. I hinted at something that we'll talk more about in the book, because these types of things are just too good. They're just too good for YouTube. There's too many yahoos out there trying to take my concepts, okay, make mentorships off of it. No credit to me. You know, I'm not gonna lay my best stuff out here. I will put it in print. That way you'll see it, and it's mine, and everybody will know that it came from me, because there's too many people still out there pretending that they found this on their own, or it's some dead guy that never talked about it, okay, and I stole it or rebranded it from them, which is nonsense. But I talked about how you can take this imbalance and multiply that out and project it up, much like I taught with my central bank dealers range, and much like I taught with flout, and how I amplified what everybody that was aware of the Asian range for a long time. I supercharged that and taught you how to use it and make it better. Okay, and I taught you in terms of standard deviations. But you can do that opening range gap the same way, and you can do projections higher, and then we have an overlap of negative 11 standard deviations, and price comes in at 4214.75, which is the basis of why I took my exit right at that low, which would be just a hair below this level here, and in 4214.75 looks like this, and we went just above it to trade into the 4215s. That was the high of the day. I'll counsel you to go look at Twitter. You can see my executions and such on the PM session for ES and NASDAQ. Market on close macro. All of this business in here was all discussed as it pertains to the PM session silver bullet and the final 15 minutes after 3 to 45 minutes after 3, that 30-minute window. That is a market on close macro. The algorithm generally will run for liquidity. Now, if the liquidity has been tapped, that means a higher time frame liquidity pool or target's been met, then it usually won't spool and start running. There's no need for it to do anything. Then if it's done that, the last 15 minutes of trading between 3:45 and 4 o'clock, you'll get some kind of little sputter move, which is, maybe it's good for 5 or 8, maybe 10 handles, maybe, but not terribly explosive. But like this, I told you last night what to expect. We were going to look for 4206. We were going to look for a 15-minute premium fair value gap, and we'd look for it to draw up into that weekly volume imbalances, that shaded area, and it delivered like gangbusters. So this is what we have here today, and hopefully you can take this information and start to see that none of this is random. None of it is conjecture. It's a logic as to why price is moving the way it's behaving and what time it's expected to do so. It's a wonderful approach to trading where you don't have to rely on any kind of indicators. You're dressing your chart up. You're trying to stay organized. You're trying to anticipate, not react. You're trying to anticipate what price is likely to do next. It starts with a draw on liquidity. Draw on liquidity is just basically where's it going to go to next. Because if you don't have that information, if you have not determined that or have the skill set to be able to determine that consistently, you're not going to be profitable. I don't care what method you use. You have to try to see where price is needing to go to next. Who benefits the most? If smart money benefits by price going higher, you can look for retail traders to get punished. What would that look like? Relative equal lows. Retail sees that as what? That's a classic support to them, right? They take it down to take those stops. Why would those sell stops be advantageous to be liquidated? Because smart money will buy those sell stops. They'll be the counterparty to that sell stop being activated. They're buying that. So they're going long there, where longs have placed orders to go long here based on this pseudo support. No. Price allows smart money to be the counterparty to those sell stops being engaged. So when those sell stops get tripped, there's a flood, a rush of selling orders in the marketplace, which is beautiful for smart money to accumulate that and be buying at a cheaper, low price. Then it rallies and it attacks what? The buy stops above here. Who would have buy stops above that? The people that were momentarily lucky, didn't take profits. They don't take partials. They don't take profits. They don't have to get out of the marketplace at the right time. Their stops is resting right above here in the form of a buy stop. Why would it be advantageous to trade there or above this level here or up into this weekly volume imbalance? Because smart money will look to distribute their longs there. So offset distribution occurs with smart money buying the sell stops, selling some above this high, selling some above here, and above here. And they liquidate that. And that liquidation of their longs above here, they're selling above here, which gives what? The retail traders the liquidity to be a buyer of when they're chasing price. When it breaks out here, who wants to buy that? Breakout artists and the smart money selling their portion that they went long down here to there, which is why I'm teaching and teach my students to sell long positions partially above old highs and to cover short positions below old lows. That's what smart money does. It does not follow retail patterns. It does not look at moving averages. It does not look at breakout strategies. It doesn't do that, okay? They don't do that. The algorithm will set up scenarios where retail traders with that mindset will fall victim to it. And you don't want to be in that category. You don't want to be a classified neophyte forever in trading with retail logic, never coming to the understanding of what these markets are actually trying to do and how they book.